Okay, folks, sorry about that as Leo's getting hooked up here. Maybe CPAs can't do this. No, I'm just kidding. Hey, while Leo's coming back here, we've been using this slide quite a bit here, which is basically we're saying, good, what's good in our business. Obviously, any product with living benefits is good, right? We've talked about term insurance. And, the reason why we use these three is because, with term, as you know, term is typically not enforced when somebody dies because it's cost prohibitive when you're older in life, right? And when that product renews after 20 or 30 years, most people don't keep it. So it's really not expected or designed to be a long-term product. Now, we've talked about already what we feel to be the best plan. And the best plan is, frankly, index universal life, because that's something you can retire with, right? We get all the benefits. We get the cash value growth, no market risk, and it's all tax-advantaged income down the road. Of course, it's designed to be enforced when you die. So you got the benefits of living benefits, of course, a death benefit, but the ultimate living benefit is a tax-free income. That's the ultimate living benefit with an index universal life. Now, guaranteed universal life is obviously a little bit different, okay? What it's designed to do, clearly, is to be enforced when you die, because it is something that you can keep until you're 120 years old. It's kind of like, you've heard Ron Petrinovich, our CEO, talk about it like a perma-term, a product that's, where term you can go for 20 or 30 years. If somebody was, say, 50 years old, a guaranteed universal life could go to, say, 100 if that's what he wanted, which would be like a 50-year level program. It's not designed to build cash value. What it's designed to do is make sure that you have coverage in force when you need it, which is A, when you get sick via living benefits, B, when you die, a tax-free death benefit for your heirs. So it's designed to be enforced. That's the key component. It's not designed to build cash value. So there's some places where you can use this here, which make it extremely beneficial. Okay, and I know that's what Leo's going to talk about. We're just having some difficulties getting them on here. But let's talk about where some of the scenarios are. Are you there, Leo?
I am here.
Okay, go ahead. I'll let you take over.
All right, sorry about that. First time being a panelist on a Zoom program. As I was listening in on what Al was saying is that, and I'm sure some of the other presentations you have seen, is that we have seen a scenario of good, better, or best. When you look at term insurance is a great alternative, but as we know why they call it term insurance is because it terminates. It's like renting. You're renting the insurance for a period of time, and it's basically designed not to be enforced when you die. Statistics show that approximately 3% of term insurance policies are actually paid out, which I found very interesting. Now, you can get term insurance, but the maximum year that you can get in terms of coverage is typically 80 years old, okay? The next scenario we're looking at is a product that came out approximately 2 years ago. It's called a Guaranteed Universal Life, and that's why we're on this call. Guaranteed Universal Life is it's what I call the better product. It's very similar to, you've heard permanent insurance, where you've actually owned the product. I call this more of what I call perma-term. It's got permanent features as well as term features. You can get coverage anywhere. Minimum is age 95, and you can go up to age 120. The premiums vary based on, again, the same way that any of the other insurances are, based on the quality of the individual in terms of their health. It has some interesting features in it that we're going to get into. And then obviously we also talked about the best quality type insurance, which is the Index Universal Life. And we're not going to get into that here. That would be on another presentation. But this is basically where you can own the product, and it's not designed to be enforced when you die. It's got a lot of tax advantage in terms of cash value growth. So what I'd like to do is, like anything that we do and what we do, is we need to get a scenario in place. And first thing we do when we meet with any of our clients is that we have to sit with them and do what? A simple needs analysis. So what I'm going to do is bring on a simple needs analysis. And here's a simple needs analysis. Actually, this was a scenario that I just went through with a couple. Both of them are around in their 50s, and the Guarantee Universal Life product has some interesting features in it. Okay. What I'm going to do is, before I show you this, I'm going to bring up the brochure on the Guaranteed Universal Life product. All right. The Guarantee Universal, they call it Signature Guarantee Universal Life. This product brochure, we're going to take a look at American National Insurance Company. AIG also has this product. I find that the Anico product is something I've been working with. And the beauty of the Guarantee Universal Life product is that it has all the features of the term, but it has the extended term, okay? So it has the ability where you can customize the length of the death benefit. You can select the coverage amount that you need. It has the riders of the accelerated benefits, okay, where you have the benefit of the critical, chronic, and terminal illness. And the best feature that I find about this particular product, it has something called a guaranteed cash out rider. All right, now what does that mean? Basically what this means is that you can receive up to 100% of your premiums back on the policy. Now, I'll say that again. The individual can receive up to 100% of their premium back if they make a decision that they no longer need the insurance policy. Now, that's huge. We'll get into some of the features on that. The beauty here is, and I'll show it to you on an illustration, is that if you go out to year 15 on the policy, they'll allow up to 65% of your premium back if you do not want that policy anymore. In year 20 and 25, you will basically get back, if you no longer want the policy, you'll get back 100% of your premium. So it's a great feature when you're communicating with a client on the benefits of basically you have the insurance in place, and if you choose not to need that insurance, you have the ability to get your money back. So I just wanted to show you that there is a brochure. Anico has these brochures. You can get them electronically as well as in the back office. You can have them, they'll mail them to you, and you can use them free of charge. You can get them as part of your package when you sit with a client. So what I want to do is go to the simple needs analysis. What I did is I worked with an individual, with a couple, both of them, the date of birth, 1965, so they're in their 50s, early 50s. I'm going to paint the scenario. We sat down with them. We looked at the simple needs, the tobacco use, both knows. John, height, weight, falls in line with a preferred. Medical issues, he's got none. He's not on any prescription meds. You look at his wife does have medical issues. She's basically taking blood pressure meds, and she is on a prescription for her blood pressure, okay? So what I'm going to do is focus on John for this presentation. In his scenario, they have some unsecured debt, credit card debt, probably about $15,000. We put $15,000 down for his final expense. Both him and his wife have one child, ready to start college within a year or so. So what I did is one child, we put down $100,000. Currently, his income, take-home income, is approximately $75,000. What I did that is as a multiple of 5, put him down for $375,000 for income replacement. So his total need was approximately $500,000. Now, if you look down here in the middle here, he has a term policy in place for $500,000 right now. but it will be expiring at age 63. So within 10 years, his policy will be expiring. It was a 20-year policy, but he got it back. He got it in place probably about 10 years ago. He's paying approximately $50 a month. Okay. And what I wanted to do is when I sat with them, I said, okay, you do have a policy in place. How's your health? We know what your health is. It's in excellent shape. But what we don't know is how your health is going to be tomorrow. What I always sit with people is I tell them, listen, your health is not going to be any better tomorrow than it is today. So what we should do is take a look at this. And when I looked at his policy, he just had the death benefit, and then he had coverage for terminal illness. You know, when we look at most of the policies, you know, right now 149 million policies are in place. Less than 2% have living benefits. And again, every time I sit with people, that is the scenario. I looked at their policy. He only had death benefit with terminal illness. Now, one of the things, again, the importance of a simple needs analysis, if you notice here, is that he's in a 401k plan, and he has on hand a little over, he's got $775,000. And so looking at this, I'm identifying some huge opportunity because, you know, I look at him and say, wow, he's worked hard to save some money. You know, how are we going to look at this gentleman? He's in his 50s, and everyone at that point in their 50s is concerned with what I call long-term care insurance. Okay. So when I sat with both of them, you know, their concern was to have the insurance in place for their child. You know, God forbid if something should happen to them, they wanted to have insurance in place to cover their education. They like the value of the living benefits, so they see the value of the income replacement. But they were a little hesitant on obtaining another $500,000. They felt that $500,000 might not be something that they would want to age 70 or 80 using typical term insurance. So I had a conversation with them about long-term care. I said to them, listen, how do you feel about long-term care? And they said to me, look, you know, we're interested in looking at that. In fact, as we had conversations with people about long-term care insurance, but it's very expensive. So what I did is I explained to them, well, what's your concern about the coverage of $500,000? They basically said, well, we don't feel we need 500 because our son is going to be out of school pretty soon. Maybe from a cost savings point of view, we'd like to maybe, you know, do 250. So what I had recommended is coming up with a scenario, and the scenario was maybe the possibility of doing a $250,000 policy for 15 years. And then I showed them the value of the Signature Guarantee Universal Life product, having $250,000 in that coverage where they would have coverage up to age 95. Now, what does that mean for them? Well, they expressed a concern about long-term care. Well, as you know, the beauty of the Anico products is that we have the accelerated benefit riders. Well, we have the critical and chronic illness coverage. The benefit is that those coverages come with the Signature Guarantee Universal Life product. And by having that included as part of the product, they're in a position that, God forbid, if they should come down with any type of critical or chronic illness, whether it be age 80, 85, 90 years old, they have the ability to tap that product. And here's the most important thing, that I told them that they would be able to preserve all the funds that they help create for them and their family through retirement savings. Because we all know how much money it costs to have long-term care. So what I'm going to do here is, you know, I gave them that scenario and I said to them that I would come back with my presentation. So what I'm going to do is actually take you through a scenario where my proposal is going to be a $250,000 term product for 15 years and a $250,000 GUL for to age 95. So what I want to do now is take you through a scenario of how to prepare on the illustration the signature GUL. Okay, so what I'm going to do is log in to Anico. Okay, we're going to go to the Expert Illustrator. Now I'm going to create a client. Over here on the left, create a client. Just keep punching all the data as if it's any other type of insurance. Date of birth is May 1st, 1965. I'm going to put in male, and I'll leave it in the state of Rhode Island. Over here on the right, on the action, I'm going to create a new illustration. Okay. Here on the left-hand side, plan type, it is a universal life product. Okay, over here on the right side, under product, you're going to go to signature guaranteed UL, and then create. So this is a standard illustration type layout here, where we have the plan, signature guaranteed UL, state I have as Rhode Island, the illustration name being, well, it was John Doe. Now, in terms of class, it's an automatic that it goes to standard. Because of his health situation, I'm going to put him at preferred. He's the right height, right build. He's not on any medicines. He has no medical issues. And what I'm going to do is, under type of illustration, I want to solve for the premium. Okay? The input option, I'm going to put a face amount. The face amount, I'm going to put in 250,000, 001. Now, the reason why we put 001 is because anything from $250,000 even or less, the best rating you can get is standard, which would require no meds. In order to get him the opportunity to get him preferred status, I have to put $250,000 and $1. Okay? If you notice down here, it says solve criteria. Solve criteria, you can go up from age, you can go to coverage to age 95, 100, 105, 121. I'm going to pick coverage to age 95. Okay. And then over here, so if you notice the target age is 95, the premium amount I'm solving for, and I'm going to pay the premium to age 95. So the individual, they'll be paying the premium for 42 years. The mode, I'm going to put in monthly. Okay. So just covering everything again, the plan is the signature guaranteed UL. The class, preferred non-nicotine. You leave it automatically solving for the premium amount. I input the face amount, $250,000 and $1. I asked to solve for the criteria to coverage to age 95, and the mode of payment is going to be monthly. Now that's it. That's all you need to input. You go over to the action side here, go to preview illustration. Okay. So here's the illustration. What I want to do is point out some key features of the illustration. So basically, it's a signature, a guaranteed universal life product.
Hey, Leo.
The underwriting class. Yes.
Sorry, buddy. You got to share the PDF illustration.
Okay. I thought I was still on the.
All right, buddy, you're good.
All right. So here is the illustration, Signature Guarantee Universal Life. Guarantee Universal Life Insurance, the underwriting class, male, preferred, non-nicotine user. The specified amount of the policy is $250,001. His monthly premium is $211.90. Okay. It's a no lapse guarantee, meaning that it's not lapse. It will not lapse as long as the individual pays the monthly premium. I just want to point out a couple of features here. It has included in that a guaranteed cash out rider, which I discussed. What that means is in the 15th year, if the individual decides not to maintain the insurance and decides to turn it in for various reasons, they would get 65% of their premium back. In year 20, in year 25, they would get 100% of their premium back. It has all the accelerated death benefit riders for critical illness. When I sit with them, I show them this. Critical illness, where it has all of the coverages. Chronic illness, this is the key, where I really get the benefit of sitting with them and showing them this, is they're getting the benefit for the activities they can't perform 2 out of the 6 daily living activities, which is bathing, dressing, eating, going to the bathroom, walking, basically, or even cognitively impaired. The benefit here is obviously as we get older, you have long-term care needs. Basically, this would qualify for having nursing care need. So I show them the benefit here, having this as a rider. Terminal illness, okay? Now, when you get down to the illustration here showing the premium outlay, what I do is I show them, by them paying the $211 per month, it shows year 1, and then I show them going all the way out to coverage to age 95, $250,000. Then what I also do is I show them, let's take a look at the guaranteed cash out rider, where we talked about in year 15, they paid premiums in through year 15, $38,000. If they decide they did not need the policy anymore, they would be able to turn in the policy and get $25,000 back. You look at year 20 and year 25, if they decided they didn't need the policy anymore, they would get $50,000. They get 100% of their premium back, $50,000 in year 20 and $63,000 in year 25. So people say to me, well, okay, that's nice, but here's the benefit, and here's some of the reasons why I give them this as a benefit. Why would someone want to turn in the policy? Well, let's say they had a policy on both husband and wife, a GUL, and one of the spouses were to predecease the other one. And the reason why they have the policies in place is maybe for protection of one to take care of the other. If one predeceases and the other one really doesn't need the insurance policy, they basically have the ability to turn that policy in and get their money back, or up to 100%. I've used this outside of working with individuals. I've used this actually working with companies, where you have owners of a company, they have a buy-sell agreement, and they're in a situation where they want to have coverage on each other. They can have coverage all the way to age 95 between the two shareholders, and they're in a position, if, let's say, they close the company, or they decide that, one maybe retires and one buys the other one out, they paid all those premiums into the life insurance policy, they can actually turn that life insurance policy in and actually get their money back. Another scenario I've used this on is an owner of a company. He purchased a building. The bank required the individual to get life insurance. So a lot of people, what they do is they just get term insurance. Well, what I did is I showed a client of mine a scenario where instead of them getting term insurance, they got a GUL because I said, look, your mortgage is for 20 years. So if you get a GUL, yes, you're going to be paying a little bit more in premium rather than a term policy. But with the term policy, remember what we spoke about, you're renting the policy. At the end of the term, it terminates and no money is paid back to you as a consumer. But the beauty of the GUL is that at the end of the term of the mortgage, they can actually turn back in that policy and get all of their premiums back on that insurance. So these are the key features of the GUL. Now, when the scenario was is that for this individual, when I sat down with them and I showed them the scenario of, look, I know you said that you didn't really need $500,000 of insurance, but you need it now. So my proposal, as I discussed, is that I said, look, get a 15-year term for $250,000. So that'll get you through the period of your earnings years, because if you think about it, they're going to be still working. Their goal was to retire at age 65. They were in their early 50s. So I said, have the 250 term for 15 years that gets you coverage until approximately age 65, get you through your earning years, and get your son through college. And they agreed. That was good. Then I said, implement a $250,000 GUL that gets you to age 95, that gives you the ability to protect the earnings that you worked so hard to preserve, where you are not putting yourself in a situation to have long-term, you're not put in a situation where you need long-term care needs, but now you need to deplete your personal savings in order to support you or your wife going through nursing care. Now, a lot of people, I'll give you an example. Both my parents, a lot of people look at long-term care. Both my parents they got long-term care insurance at age 65. They've been paying approximately $3,000 a year since age 65. They are now 86. So if you add up the amount of money that they've been paying for long-term care, it's approximately, let's say, $60,000 over that term. The problem with long-term care, and I explain to clients, is that long-term care is like car insurance. Car insurance, we all know we need to have it. We need to have it in place, God forbid, if something should happen. But at the end of the day, if you don't use it, you lose it. So by them now switching to an alternative of having the GUL as a long-term care alternative, the benefit of that is that, yes, they are paying a premium. They're getting the critical and chronic illness coverage. But here's the best part. You got a couple of great things here, is that if you need it, you have it. You can tap into the accelerated benefits by having the critical and chronic illness coverage. But let's say they don't use it and they die before they use it. The benefit here is that all their premiums that they paid in will actually be paid as a tax-free death benefit to their heirs or to the spouse. So, this is something where they can actually, in some way, some shape or how, they're going to end up getting their money back. And most people, when I explain it to them that way, they see the value of this and they feel that this is something that will be extremely beneficial to them. So what I wanted to do here, just go and take a look. Just wanted to bring up a new share here. So I just wanted to kind of recap the benefits of a guaranteed universal life product. The first thing is it provides for family basic life insurance at affordable pricing. It's a permanent life insurance benefit. And in the event of a qualifying illness, have the ability to exercise the accelerated benefit rider for the critical, chronic, or terminal illness, to really to ease the financial strain where they're not putting all that pressure on themselves to end up using all of their retirement proceeds or even the value in their home to pay for long-term care. And then in the event any of your insurance needs change, the product has a guaranteed return of up to 100% of the premium at no additional cost. So, I tell people it's basically, no, they're not going to get any extra money back, but it's like putting money in a coffee can, that they're in a position where they can have this insurance in place, and if they don't need it anymore, they can get their money back. And then lastly is that it becomes a tax advantage wealth transfer to the heirs. So I hope this kind of gives you a good recap of the benefits of the Guaranteed Universal Life product. And as always, individuals can reach out to their trainers if they need some additional assistance, or again, going through field training. Once you do these a few times and you understand the nice features of the Guaranteed Universal Life product, you'll find that this is a great tool to have in your bag. And it's definitely a tool that a lot of insurance companies don't provide, but Anico is a great provider of this product, and the pricing is very, very reasonable. So thank you for your time.